It's great to see you again, Abhay. What kind of shift are you talking about?
Well, the EU has been in a deflationary malaise since the 2008 financial crisis. And there's ever since been this concern that the EU wouldn't last. The Germans even created a contingency plan in 2017 for that scenario. But what's happened since, of course, well, first is COVID. And the reaction to that was to announce $1 trillion debt finance recovery plan with governance commitments for Greece and Italy. This is kind of basically Germany recommitting itself to the European project. Very importantly, that was the first thing. They reversed their posture towards inflation and the idea of debt, which of course they have this allergy to because of their post-World War I experience.
Right.
And now thanks Putin, but now they have recommitted to rearming themselves. And so it's completely reversed their post-World War II posture. And I mean, of course, the latter part, it still has to be accepted by the voters in Germany. So one could argue that contrary to the market's view, the EU now has the makings of a more stable bloc because they have the three fundamentals of a federated government falling into place: common representation of people, common fiscal policy, and now potentially a common defense. If this is all true, this would make its currency and its stock markets a good place to invest for the long term. But of course, there's the elephant in the room, which your previous guest mentioned, the short-term risk from energy prices. From our view, there's a balance there. The currency and the equity markets in Europe are very undervalued compared to the United States. So maybe they can absorb the short-term hit.
So what's the implication for investors, Abhay?
The implication for investors is that there's this panic because, I mean, obviously, and for good reason, people are focusing on the moment now. But then maybe, a few months from now, what will have happened is that, there are really two options. One is the Putin regime fails. And now, even 2 weeks ago, we would have put that as 0% chance, but it is a possibility. And then the two more likely option is that there's this new status quo develops, and it's going to be a security status quo that is new to Europe, and the US will be somewhat involved. But it basically means that nothing really changes on the ground for the Europeans, other than, they've got their unit, a long-term concern over Europe as an entity may be removed. So that's positive news for both the currency and the stock market long term.
Yeah, positive news for the currency, positive news for the stock market. So does it make you want to favor investments in Europe right now? These long-term trends mean sometimes we don't see their fruits play out for a very long time. Or do you think people can start making moves right now to capture the upside that you see?
Well, for us anyway, it's always, I don't buy an index, right? I go in and find companies. I think that's the way to do it. Pick stocks that are kind of isolated from the buffeting from all these these sort of, these macro trends. And there are plenty of companies that we find over there that are not affected by interest rates or energy prices or what's Putin going to do tomorrow. Air Liquide is a very good example of that. They basically pass through all their costs to their customers. It's a secure business. The fertilizer space is a very attractive one for us. So, we're finding it, as we always have been able to find interesting things to buy. There's a very broad market. People talk about Europe as if it's just one country. It's not. It's a lot of different countries. And depending on where you look, there are definitely opportunities available.